gonna keep my chat up, but it's gonna be hard for me to kind of look back and forth through everything. So I'm gonna do my best. But let me introduce myself really quick. I'm gonna give you a little bit about my background, and then I would just love to just start peppering me with questions. So, um, hi, Patrick McMillan. I live in Utah. I'm from Tennessee. I'm known as the QofE guy. Let me kind of give you a little bit about my background and how I got into QofE. QofE is quality of earning. So I'll kind of talk about what that is here in a second, how that plays in, why that's important to you and everything. So I'm from Northeast Tennessee. While I was doing my undergrad, I got into accounting. I love numbers. I've always loved it. So I got a job doing accounts receivable, then switched around, started doing some mortgages and some loans and everything. Moved out here to Utah, got caught up in the real estate bug. Excuse me. Started buying, flipping, selling homes, holding homes, things like that. And around that time is when I bought and sold my first company. What does that mean? And I'm going to talk very generalist just for a quick sec. I bought my partner out of our real estate holdings company, and around the same time frame, I sold my mortgage loan processing company to one of my clients. So I kind of got into some M&A, but full transparency, I had no idea what I was doing. I still didn't know what I was doing, after I had done it. It was very different for me. And so through time, did that, moved out or was out here in Utah. So 2008 hit. Real estate market crashed. I lost a whole lot of things there. Got a job. And in that job, I started learning a whole lot more about accounting and finance. Was a controller, became the CFO. And there's only a few companies listed here. I'll give you a little bit more background about that, or you can just find me some time and ask me more about it. But with those companies, it was a conglomerate of companies. We had several different, or we had three industries, many different companies, 550 employees, about 4 dozen different bank accounts. It was crazy. We grew a lot organically and a lot through mergers and acquisitions, buying and selling stores and other companies and things. No, we were not private equity. We were just a group of crazy people. So I did that for a bit, and then I needed a break. And so I became what's called a fractional CFO. So I left full-time CFO role, became a fractional CFO. I picked up 7 clients and just helped them independently. Learned that I needed to be able to expand a few things, my time, my knowledge, and services and things. And so I joined a firm, and that's where you see in the middle right here, Amplio. Since then I have become the transaction advisory lead, and so anytime when someone is buying or selling a company, I or my team come in and we do what's called financial due diligence or quality of earnings. That's why y'all are here. So let's do a quick, hey, what is FDD and what is QofE? Financial due diligence, when you're buying or selling a company, whether you're a company buying another company, or whether you're a person buying a small business, you got to do what's called financial due diligence. You dig in, you try to find out a lot more about the financials of the company. What are they representing and what's happening in reality? One of those components is a quality of earnings, or a QofE. A QofE is different than an audit. An audit will tell you what a company is doing that's in compliance with GAAP, generally accepted accounting principles. A QofE will tell you how they're doing that and why they're doing it that way. Because keep in mind, GAAP are principles, which means there's still a lot of things that they can do. And so let's dive in. This is more than me just talking. I want to hear questions. I hope y'all came with questions because we only have a half an hour total, which means we have about 23 minutes left. So please, and now I'm looking at the videos, and sorry, I've got 2 screens going, so it's going to look like I'm not looking at y'all, but I am. So if you have a question, please raise your hand or throw it in the chat. And my first question, y'all, to get things going is, why did you come to this? I mean, what in the world made you say, hey, I want to go learn from this crazy bald guy? What is, and let's look at the name of this again, what every buyer should know about financial due diligence and QofE. Why are you here? What do you want to learn about? Heather Barber, I'm your number one fan. I could tell y'all stories about Heather. She's fun. We spoke at the Utah Business Forward event. Okay, here we go. Here's some questions. All right. Let's see. What is the biggest red flag on QofE? Oh man, I'm gonna share a story about some red flags. Actually, I was talking with someone this morning. He's a potential client. He's acquired businesses before, many times, but he's looking at one today, and he already has them under LOI, but he's digging in. He hasn't engaged me or anybody yet to do financial due diligence, but with doing some acquisitions before, he kind of knows what to look for. And so what happened with the target, the company that he's buying, is their revenues increased. They were at 7 million, 8 million, then 10 million, then 11 million over the last 4 years. That was kind of their trend. And their earnings kind of followed that same trend, but higher. And in the last couple of years, their earnings, the net income or the EBITDA or whatever it is you want to call earnings, right? Tanked, dropped. That's a red flag. And why? And I told him some things to really ask the buyer is what are the drivers behind that drop? Because at surface level, just the very few things that he was sharing with me is their growth was not sustainable. Their earnings continue to grow, but something happened, which to me, it sounds like maybe they were realizing that they didn't have the right people, the right systems, or something. And so that's why their EBITDA dropped quite a bit. So that's, I don't want to say it's, people always want to hear red flags, and for me red flag is really dependent upon it's the eye of the beholder. For you, a red flag might be something that for me might be an orange flag or a yellow flag, or even a, oh my gosh, I could really take this and make it better, and run with it. So there's that. Okay, let's see. From Andrew, if I can do it, or if I need to find someone with finance background. Oh my gosh, Andrew, I love this question because I posted on LinkedIn, I don't remember, a couple of months, 2 or 3 months ago, maybe it's several months back. But anyway, a lot of people with financial background, especially FP&A, financial planning and analysis, are like, oh my gosh, I've built models. I can do the QV myself. Yeah, you can. Guess what? I've looked at a lot of tax returns. I'm not a CPA. I hate taxes. I've looked at a lot of tax returns, but I do not want to do the taxes myself. I want to hire someone who does 1,000 taxes a year or a month or something like that. And that's the difference. You hire someone like me or my firm. We've done hundreds of these. I've been involved on there again 2 deals of my own. I'm an angel investor, and I do financial due diligence on the companies I invest in. My firm has acquired 5 companies. We're closing our sixth, let's see, next week, and we've got 2 more under LOI. I do all the due diligence on that. You want to get someone who has done this time and time again, and they can grab those things and find them very quickly. They've been involved in a whole lot of deals, and you paired with them can really, really gather quickly all the information, or at least the majority of the information you need about that company. Yes, you can do it yourself, but you're going to miss some things. So that's my answer to that. Pricing, Daniel, good question. Here's where I'm going to give you an answer that's going to be very different than a lot of people that you're going to hear. So pricing for FDD and then subcategory quality of earnings, you're going to see pricing anywhere from 5 grand to 500 grand. And that 5 grand is going to be, and I call them the onesie twosie shops. That's the 1 or 2 people that have, partnered together and they've done a whole bunch of these, and they're going to charge you a very little amount because they've only done a few deals, or maybe they're outsourcing it to another country. I'll just leave it at that. Maybe they're using a whole lot of AI and they haven't done a lot. I caution you against that. And I've got a story about that here in a sec. Let me go to the other end, the several $100,000. That's the big four firms. Y'all don't need any of those, okay? My firm, our range for a quality of earnings, and I'm going to stick to that for a sec, is 20,000 to 45,000. Now, if you're thinking, oh my gosh, Patrick, that's too much. Now, remember, a quality of earnings is a very, very deep dive. If that's going to bring a machine gun to a water gun fight, as I mentioned a lot of times, maybe it's a smaller deal, $1 million deal, and you don't quite need a QofE, then I have something that's called an FDD workbook, which I charge 10 grand for. It's not a quality of earnings. If you want to learn more about that difference, set up some time, on Leland and let's chat about your specific deal. But the reason why I caution you against the onesie twosies, I'm going to bring up an example. This happened earlier this year. I had a potential client came to me. I quoted, my QofE price, and they said, "Thank you, Patrick." They talked with a few others, and they went with someone who was half the cost. A few weeks later, that potential client reached out to me and said, "Hey, Patrick, can you help me with networking capital? My QofE person, the seller, and the broker, all three on the deal, could not come to a good decision on networking capital. And they needed someone that had a lot of experience to come in and do that." Had he engaged me from the very beginning, I could have helped that deal. But when he came to me after and said, "Can you help?" Before he could even say yes, he responded again and said, "Never mind, the deal died." And so it's one of those things where, if I am more than just an Excel jockey, and it's not just me. I run a team as well, but we're more than just Excel jockeys. We love to be deal advisors. We've done a lot of deals, and so we can really get in there and help you negotiate. The guy I was talking with this morning about, what was going on with the trajectory. I really gave him some stuff to go back to the target and say, "Hey, ask question 1, 2, and 3, and A, B, and C." To really understand how you can renegotiate that LOI. So, okay, here we go. Let's see. What are the main things that you look at the financials when analyzing business? Everything. A lot of people only think about it's all about the income statement. It's about the earnings, EBITDA, earnings before interest, taxes, depreciation, amortization. It's about the free cash flow. Guess what? All those answers are right. But I'm going to tell you more. It's about the balance sheet. The balance sheet will really help you to understand, how did they create those earnings? Okay, how did they finance the business? What's the debt and debt-like instruments? What are the accruals? And accruals could be assets or liabilities. For example, let's talk about construction. For example, there's a whole lot of stuff going on with construction right now. And a lot of small shops, small companies, small, a few $1 million or less, that are involved in construction. Okay, I'm going to give you roofing, for example. I'm doing a roofing roll-up. There's 9 entities in it. And their cash basis means they're recording their revenues as everything is hitting the bank account. Well, guess what? On some of those roofing deals, they're requiring a deposit. And that deposit hits the bank account, and that shouldn't be recognized as revenue yet because the project hasn't been completed yet. And it may take 6 weeks. It's bad for a roofing, but it's just there again with numbers here. It may take 6 weeks. So I get the deposit today, but it's not going to be delivered for 6 weeks. Oh my gosh, that might be sometime in January. Then I have to make sure that that revenue is not recognized now, but recognized in January when it's finished, which will hit the balance sheet at the time. Okay, it's an unearned revenue. And I also have to make sure, okay, well, buyer and seller need to talk about who gets that cash. Seller's going to want to keep that cash because we're like, well, I earned that cash. No, you didn't. You didn't deliver the service yet. And buyer also wants to make sure that they have enough cash to continue working in the business. So what do I look at? I look at everything. I also look at customer concentration, vendor concentration, trend analysis, benchmarks. Hey, if this is in the roofing industry, then, what are the benchmarks as far as gross margins and earnings, and how much cash do they really have in the bank, and net working capital and cash conversion cycles and things like that. So really making sure that the benchmarks are matching. And if they're not, then that might be good, because if they're under benchmarks, then maybe you as a buyer can really lift that. And that's kind of one of the reasons why you're buying a company, right? I mean, you're hoping that you can make some improvements and improve the cash flow. It means you can get at a discount. It's kind of like when you buy a house. Hey, it needs some stuff that needs some work on it. Then yeah, you can get at a bit of a discount. Maybe do some of the work yourself and increase the value. It's the same thing with business. So I like that question. Let's see. Shaquille, learn about FDD 101 for ETA. I am new to ETA. FDD 101, I tell you what, and it really depends upon what your background is. A lot of people who are buying a company, and I'm going to kind of go two extremes. There again, let's say you have some financial background, so you are familiar with looking at finances, then that's, kind of one way that, an FDD person or a QB guy can help you versus someone who's, oh my gosh, I've been a programmer my whole life. I've never looked at financials, and that's a whole other thing. So really, the biggest thing that you need to do is to be able to ask for the financials and get, I know a lot of people are like, oh, get 3 years. That's good. Let's get 5 years because we still have this thing called COVID that happened 5 years ago, and some companies got the COVID bump. And so you really want to see what happened before, during, and after, stuff like that. All right, let's see. Gustavo. Hey, Patrick, do you do QofE or is it a larger team? Do guys specialize by industries? So when I first started, I was the only one doing the QofEs. Now we have 8 of us that do it, and I manage the team, but I also do the QofEs. I still have my clients. I'm doing 2 roll-ups, accounting and roofing roll-up, and I'm doing QofEs on all those. I also have kind of 1 or 2 QofEs that I do on this for other clients, but I have a team. Typically, the way that we do it is we will put one person that's doing the entire deal with you. So let's say it's Edwin. He's one of my guys that does QofEs for me. Edwin will be the one that's working with you as the buyer, with the target as the seller, any brokers that are involved. He's doing the entire QofE. He's asking all the questions, running all the numbers, and doing the drafts and everything with you. And then he'll run it by me. I'll look at the draft and then he'll deliver the final. So it really depends. That's how my firm does it. Now, these onesie twosie shops, it's kind of similar, but they've got one person. There's no oversight. There's no one that's kind of giving a second or third set of eyes. Maybe they do ask them. So whoever you engage to do your financial due diligence or your QofE, ask them, hey, is it just you? Do you have a team? Do you outsource it? Who do you outsource it to? What's their experience? What kind of oversight do you have? Ask all those questions because that's very important that you understand what their process is. Let's see. What are some of the non-negotiable deliverables in QofE, e.g. tax return to accounting, cash balance, rec, EBITDA adjustments? Okay, I love this question. Thank you, Ruben. The reason why I will definitely decipher my QofE between an FDD workbook. My QofE, the non-negotiables are cash proof. That means I have to take the bank statements and make sure it matches what's on the income statement. And there's always going to be some adjustments to that, okay? Non-revenue items being deposited in bank. For example, if they get a loan from a bank, that's a non-revenue deposit. They also have to do AR adjustments. So cash proof is a non-negotiable for QofE. Number 2, customer concentration, vendor concentration, margin analysis. If there's inventory, I have to make sure that the inventory is costed and valued correctly, costed on the income statement, valued on the balance sheet correctly. I look at all the balance sheet items. So again, debt and debt-like items, accruals, reversals. A lot of companies are cash basis. And so on a QofE, we've got to make sure that we're doing as much as we can to an accrual conversion. That's so hard because there's so many nuances in there, but we're at least going to do the best of our ability to the best of our knowledge based on the assumptions that we have. Those are non-negotiables for a QofE. And that's where there, again, some firms will call a QofE light, stripping some of those things out. I just say, that's not a QofE. That's just kind of some general financial due diligence. That's why I determined the difference there. So EBITDA adjustments, absolutely. That's always part of a QofE. EBITDA, earnings before interest, taxes, depreciation, amortization. You might see my shirt here. Warning, may start talking about EBITDA. Don't get me started on that. That'll last all day long. I will say this. Yes, EBITDA is important. it's not always about EBITDA. Adjusted EBITDA is normalizing what the earnings are. Normalizing meaning what would happen on a normal I don't want to say reoccurring, but normalized basis year over year. What are you as a buyer expecting a company, to how a company to perform after you buy it? You have to remove the non-operating items. In other words, let's say they paid their neighbor to come clean their house, but they used the business to pay for it. That's not business related. So you got to remove the non-operational items, and you got to remove any non-recurring items, any one-time items. For example, I've seen lots of QVs where a business, oh, here's a perfect example. Did a QV a while back on a business who, hey, during COVID, they decided to start selling sanitizer. It's kind of in their line, but kind of not. They just saw the opportunity and were able to do it. That's a one-time thing. It's non-recurring. It's not part of their normal business stuff. So we definitely adjusted for that. Well, okay, let's see. I know I'm just kind of hammering through these. We have about 6 more minutes and a whole lot more questions. So let's see. Matri, can you break down the process of creating a QofE report briefly? As in, what would it typically look like, the steps involved, etc.? Love that question. That's gonna be a long answer. Matri, please, please, please schedule some time with me. I actually have a QofE sample, that I've published out there, and so maybe there's a way I can be able to get that and send that to everybody. Leland team, let's hook up later and see if we can get that together. Okay. Shanti, I hope I'm saying your name right. Is it common for management to mislabel one-time EBITDA adjustments all day long? Yes. If so, how do you differentiate between a true one-time adjustment versus a recurring operational issue that management is trying to label as one-time? Questions, a whole lot of questions. Let me give an example. This is something that I labeled as a one-time adjustment and I was wrong. So for example, one time I was doing a QofE on a business and the rents were all over the place. And the broker said that this is a one-time adjustment. They're not going to need to pay rents after. So after asking a lot of questions, what happened was the rents were between a friend and they were just kind of paying as needed. And so the broker was like, oh, well, because that was a friend, it was a related party, we're going to adjust that and say that there's no rents needed. But the way that the business was going to run after, they needed an office space. And so we had to go in and kind of negotiate that. Another thing, and brokers, I love brokers, but they're notorious for this. They try to push the valuation up as much as possible. They try to push the EBITDA up as much as, not all of them, but a lot of them. And so they will put a lot of one-time adjustments in it. They're not really. I'm going to give you guys a very quick sniff test, okay? If they're calling it a one-time adjustment, but it's happened over 2 or 3 years, that's not one time. That happens all the time. And so it's not an adjustment. Sorry. I'll give you another example. A failed marketing spend is not a one-time adjustment. That's R&D. That's part of business. If you put some marketing dollars to a billboard, and I'm just using that as an example, but you get nothing out of it, I'm sorry, that's a failed business expense. That's not a one-time adjustment. One-time adjustments are things that are actually, this attorneys, for example, if it's a lawsuit and it's one time in 5 years, that's a one-time adjustment. That's a normal thing. You can adjust that. So let's see. Am I like that? Generally, how long will it take? Oh man, I go back and forth on this so much. So we generally take 4 to 8 weeks because we're going to do a very solid, we prioritize quality. Let me teach you guys something about economics real quick. What's the first principle of economics? A lot of people are going to say it's supply and demand. That's wrong. That's the second principle of economics. The first principle of economics is trade-off. Okay, if I'm going to put $1 here, then that's $1 I can't put over here. I can't use it multiple places. So 3 things that you're always trading off: quality, price, and speed. So I ask my clients when I'm getting ready to engage them, I say, okay, and I teach them that same thing I just taught you guys. And say, okay, put those in priority for you. And it's different for everybody. And there's no wrong answer. But if you prioritize quality and then speed, and then price, then that's where my firm is a great match because we're absolutely making sure that we're going to deliver quality. Speed, you'll have firms out there, and I used to work with one of them, and he's phenomenal. He delivers a QofE in 2 weeks. He's great. He's one of the best I've seen for a 2-week QofE. But there's also some quality that you're probably going to miss, and I've seen some misses on it. So this really depends. Okay. It also depends upon how long does it take the target, the seller, to get answers back to you. Oh my gosh, let's see. What industries do you specialize in, Gustavo? My firm has been around for 30 years. When I joined, we had 40 consultants. Now we have over 300 professionals. We have done work in every single industry. But for my QofEs, we've seen quite a bit in the home-based services. Think like HVAC, pool services, roofing, things like that. We've done quite a few on those. We've done some software, some hardware, a little bit of manufacturing. We've done actually, I tell you what, let me get my spreadsheet pulled up and I'll tell you a few other. Oh, I can't, it's behind all this. Those are kind of some of the, a whole lot of e-commerce, a whole lot of like nutraceuticals and things like that. Oh my gosh, I have one more minute. Let's see. I'm just going to, yeah, thank you, Leland, for putting my info up there. Here we go. Do I negotiate with the seller or provide the arguments for the buyer? Absolutely. And I've been on both. I've jumped on calls between buyers and sellers and helped them multiple times. That's actually, I think, is a good value add. Some QofE shops won't do that. I love doing that because I've been there. I've been on both sides of the table. And I'm on both sides of the table with our acquisitions too. Okay, last one. How often will the QofE yield better earnings than the original financials? Not often. I'm actually going to caveat that answer. Not often, because if let's imagine that all of y'all own your business and you're saying, hey, Patrick, I'm getting ready to sell my business. What should I ask for it? So I'm asking you a bunch of questions and I say, okay, well, your range of values, your range of multiples is going to fall between a 2x and a 6x. Automatically, what do you lock on? The 6x. Why? It's your baby. And because you think you've run that company so streamlined and so good. Well, really, when you benchmark that against everyone else, everyone really falls in that middle to bottom because it's only the top 10 to 15% that really run on that top end. And so I have to help a lot of sellers kind of talk them, or I don't want to say talk, but understand that their baby is a baby, yes, but there's a whole lot of other babies that are running it on the top end a lot better. And so I'll tell you a way to mitigate that. I do a lot of sell side QofEs as well, where I'm helping sellers prepare for people like me on the buy side. And that's great because I can know how both sides. And so when I'm helping sellers prepare that, and even better, when I'm doing that for 2 or 3 years, then that really helps them get on that top side. So how's that? Guys, oh my gosh. I feel like this was just exactly what I was hoping for. So I'm really glad that everybody joined. Please connect with me on Leland. I'm hoping, and I will work with the Leland team to see if I can send out, I actually have a couple of samples I can send out. One's an actual QofE that's redacted, and one's an FTD workbook. So you can kind of see what the differences are between those. But guys, if you have any other questions, please definitely reach out to me on Leland. Schedule some time. Let's chat. Okay. Thanks. Leland, how do I even, oh, here we go. There we go. You guys can see that. Visit my profile. I totally forgot to flip to that or set up a call with me. So, Leland, is there anything else we need to do, or do we just hit end or stop or what? This is my first one with y'all.